And our next one coming up is on California and AI, artificial intelligence regulatory policy. That's coming up in the same room on July 8th, and we will have some information on that. Probably posted on the Capital Weekly website next week, but if you are interested in that issue, we will be presenting a similar format conference on that. So with that, I'm going to turn you over to Capital Weekly editor Rich Eisen and our third panel of the day, which is where do we go next? What happens? We have now seen sort of the setup for how things are right now, how things are in Los Angeles, and now we're going to have a look forward. So thank you so much. Again, we will take questions the last 10 minutes or so. And Rich, I'm going to hand this over to you.
All right, thank you, Tim. And that is AI coming up, not A1. So anyway, welcome to this panel, and we are taking a look ahead. A lot of ground has been covered in these first couple of panels, and I really want to express my appreciation to all the panelists and folks who've come and lent their great insight to this. You know, at the risk of grossly oversimplifying this situation, our insurance crisis that we're experiencing in California, I think can really be broken down into two main categories: affordability and availability. We've heard those two words a lot today. I'm really happy to be moderating this panel because I like to always be focused forward on what happens next. So appreciate this panel too. So with all that in mind, let's start with those two, availability and affordability. And you know, maybe just a very general question, which do you see among our panelists here as being the bigger issue right now, and which is most likely to be the major issue as we look into the future over the next few years? I'm going to start down at the end. Again, I'm not going to introduce the panel because they're all in our bios, but John Norwood, who of course is... I'm Roger. Yeah. You can introduce yourself really briefly, if you would, please.
John Norwood. We have a lobbying firm in Sacramento, represent a number of insurance interests as well as other companies and associations and business groups. Probably our oldest and longest client is the Independent Insurance Agents and Brokers of California. And I just want to say on behalf of them, I'm upset, mad, and frustrated as well. So I just wanted to follow the insurance commissioner on that point because our members don't have product to sell. And it's been this way way beyond, or way before March of 23, when State Farm said that they were taking a pause and people all of a sudden decided that we had an insurance crisis. Companies that our members write with started bailing out of California after the 17 and 18 fires. And so it's been a long road for our members. They're parts of their communities. They grew up with many of the people they insure from a personal line standpoint as well as a business standpoint. Again, they don't have product to sell. They're trying their best. And basically what they have to do is go in the fair plan or the non-admitted market because the companies they do have are restricting the number of applications they can file under threat of deleting their agency authority. So, when we look at it, that would all go to availability right now, but the bottom line is the fair plan is available. So I think the biggest problem right now is affordability. The market is the fair plan, quite a bit more expensive than people are used to, or going into the non-admitted market, which is maybe sometimes multiples of that. Non-admitted market is basically picking the best risks right now. Fair plan has to take just about everything. And, so that's, I think, where the issue is right now.
Senator Nilo.
Am I on?
Yes.
So if you ask me the question, is the bigger problem affordability or availability, my answer is yes. Right now, obviously, availability is the acute issue, but when we move out a couple of years, assuming we're able to see some movement on the availability, affordability is most definitely going to be an issue. And I'd just point out that there are things that we need to do to try to address affordability, like forest management and the like, to try to mitigate the impacts and home hardening and all of that, which I think we'll talk about a bit later. But if we achieve the availability that we're looking for, I don't think we can expect to all of a sudden see prices go down. Because kind of what we're seeing is a price control situation where a product is being statutorily, if you will, priced below the market. If that weren't the case, we wouldn't have the availability problem, right? And if you've ever seen the operation of price controls, they work for a little while and then they're taken off. When they're taken off, prices balloon back up to where the market should be. And unfortunately, that's probably what we're going to be looking at with regard to insurance too. So right now, availability is crucial. And in order to address that, we need to see that the market is priced legitimately according to the risks that are involved. And the fact of the matter is it's not going to be as inexpensive as it was 5 years ago.
Alex, I don't know how you feel about answering this question because it's a policy question, but if you have a thought, please weigh in.
Yeah, no, I'm the scientist in the panel from UCLA. I would just add that it is a non-stationary risk environment that we're in, and from the scientific perspective, we're not making enough progress on the forest management. We're not making enough progress on the ignition control, and we have a changing climate that is proceeding, unfortunately at a rapid pace. We're not controlling emissions globally, and so I think the hazard is increasing. And if we do have an environment where we're trying to control costs through price control measures, then that really does create it's a recipe for a very irrational market. So, yeah, I just wanted to insert that the hazard is changing over time.
I think we can all agree with that.
And go Bruins.
Yeah.
Ms. Ritter, please.
Thank you very much for having me. Denny Ritter, I'm here on behalf of the American Property Casualty Insurance Association. So we're a national trade that represents home, auto insurers, commercial insurers, workers' comp, really every line of insurance except for health and life insurance. I am going to focus a little more that currently our struggle appears to be rooted in an availability crisis. I think when you look at the growth of the FAIR plan, that shows us that the admitted market is not showing up in the way that it would in a healthy market. And I think if you listen to the town halls that follow some of these events, I'll go to Orinda, for instance. There were a large number of policies that were canceled in Orinda last year, and there was a town hall to discuss it. And several folks there said, we would be willing to pay more for insurance, we just want to have access to it. And I've heard a few assembly members say that during hearings. So I think there's a recognition that insurance prices need to increase to meet the risk that we're covering. But I think in the future, you will be looking at an affordability challenge. And I know no one wants to hear this, but California is actually really underpriced compared to the rest of the country when it comes to homeowners insurance. And in what other sector can you say that California is the most affordable? That's remarkable. I read shortly after the fires in the LA area, Reuters came out with an interesting story about the cost of insurance in California compared to the rest of the country. And one of the stats they shared was that for policyholders in the Palisades, they were actually paying less for insurance than 97% of other zip codes in the US. We knew that was a risky area. It's certainly an expensive area, and I think that just shows how underpriced we are in California right now.
We've heard a lot about the FAIR plan today, and I definitely wanted to ask a couple of questions about the FAIR plan, but I think I'm going to moderate on the fly because even I didn't have the numbers right. I think it's even bigger than I realized it was coming into all this. There's all these efforts legislatively to maybe bolster the FAIR Plan. Let's just talk about the sustainability of the FAIR Plan. Given efforts to, as I said, to bolster it, to prop it up, to keep the money flowing. Denny, let me start with you. We'll work back this way this time. What really, looking forward, needs to be done to two things, to make sure that the FAIR Plan is viable, and also part of that is we're seeing so many people go to the FAIR Plan that don't even live in areas that are considered high risk. How do we bolster the plan while also discouraging people from taking advantage of it that shouldn't be in that plan?
That's an interesting question. I don't think people are going to the FAIR Plan because they want to. I think that they're going to the FAIR Plan because that's what's available to them. I do think that, and this is not to pick on the agents at all, I think that there is, in addition to the admitted market, there is the surplus lines market. And I won't get too deep into the weeds into that unless you want me to. But certainly there are companies there that could also help take some of those customers off the market. I think the other thing that is important to consider is the FAIR Plan, again, no one wants to hear this, is also underpriced. They went to the Department of Insurance in 2021, and the indicated rate need was 70%. They didn't ask for a 70% rate increase. I think they knew that would be eyebrow raising. They asked for a 40% rate increase. This process took 2 years, and in 2023, they were given a 15% rate increase. So when we talk about the sustainability of the FAIR Plan, I think first and foremost, it needs to be accurately priced so that it's not competitive with the admitted market. And so that when there is a large loss like we saw in LA, they can cover those losses. I think that's probably the number one thing that needs to be done. And then, of course, if you make the admitted market healthy, which I know is the intention behind the sustainable insurance strategy, and we are really optimistic that that is going to stabilize the market, our hope would be that that, just by its very nature of having a healthy admitted market, will depopulate the FAIR Plan long term.
I'm going to give the floor to my more qualified colleagues to talk about this.
Roger, in specific too, because you're currently in the ledge, so I know there's some proposals over there right now. So just looking forward to maybe those or anything else that could be done in this regard.
Well, first of all, the problem that we're seeing with the FAIR Plan is proof that the market is in crisis. It was established back in the 70s, I think, to be an insurer of last resort when people can't get insurance, and it was viewed to be an exception at the time. And it's important to know that all of the insurance companies doing business in the state are on the hook for the FAIR Plan. So if they don't achieve rates to keep their reserves up where they should be, and they're not able to make claims, well, the FAIR Plan doesn't go broke. It puts its hand out to other insurance companies. And so that then contributes to the availability problem that we have here in the state. So there is that fundamental issue, and the sustainable insurance strategy was mentioned, and I just have to say, I heard that the insurance commissioner spoke earlier, and he was talking about what he's doing that prior insurance commissioners didn't do, and he's right about that. But this crisis didn't just pop up in 2024. We've known it since he's been insurance commissioner, and acutely in the last 2 or 3 years. And it took him that long to come up with the sustainable insurance strategy. And I would point out he hasn't implemented any of it yet. It's just a document. So that is, I'm happy to see that hopefully will make a difference. But the fundamental problem we have with the insurance market and with the operation of the FAIR Plan is Proposition 103, which was passed by the narrowest of margins about 40 years ago, I think, authored by the man that started Consumer Watchdog, who plays the role of intervener in terms of the rate process, which is part of the difficulty of getting adjustments in rates and why sometimes it takes so long. And the real problem with reforming Prop 103 is it has to be done by a proposition going back to the voters. And the insurance industry isn't going to sponsor that because that would automatically defeat it in popular minds. And if we were able to have a reform of Proposition 103, well, the whole system has enriched Consumer Watchdog because as an intervener, they get paid for that. Consumer Watchdog has made literally millions of dollars over the course of time, and they have plenty of wealth to completely defeat any proposal for Proposition 103. So that's a very serious issue. Hopefully the sustainable insurance strategy can make a difference. Hopefully we can address the availability problem. Hopefully we can do some of these mitigation things that can help to keep rates from getting too high, but it really is a challenge in the market because of Proposition 103.
Roger, I want to just clarify one thing, John, before. There is language, I mean, you can reform Prop 103, but my understanding is the language of it makes it almost impossible to do in the legislature, correct?
It has to be, first of all, 3/4 majority in the legislature, and also the legislative change has to be consistent with the intent of Proposition 103, which of course would be subject to interpretation, which of course the Consumer Watchdog would most definitely oppose.
Yeah, on the FAIR Plan point, probably in the short term, most important thing right now is to get AB 226 enacted and signed by the governor. That bill would allow the FAIR Plan to issue cat bonds to deal with their cash flow. There's already been $1 billion assessment from the FAIR Plan. If you look at all the numbers and the way the reinsurance is structured, there's liable to be one or two more. In order to moderate the effect of that on insurers and the public, these cat bonds would allow the FAIR Plan to raise money and then stretch out the payments over a period of time. That's exactly what we did with the California Insurance Guarantee Association in the early 2000s when 30 workers' compensation insurance companies went insolvent. Claims were in some months $100 million a month, and they didn't have the cash flow to deal with it. So they issued cat bonds, and they were able to then spread out the assessments over 10, 15 years in order to be able to deal with it. And so I think that's the most important thing in the short term. Long term, obviously, we've got to make the market healthy again and get people back. Once we do that, I think there's all these carriers that are not writing the property insurance on for customers, but they're writing their difference in condition policies. So they know those policies. Most of them used to write the property insurance on those policies. So the carriers can go back to meet the standard. The insurance commissioner has indicated in his program to go back and rewrite those policies to pull them out of the market. And that can happen quickly. So that's, I think, where we have to go.
John, let me stay with you for a second here because we have talked a lot today too about the insurance commissioner's sustainable insurance strategy proposal and reforms. A couple of those are really interesting to me. We've talked a little bit about catastrophe modeling, but also being allowed to factor in the cost of reinsurance. And I think reinsurance is a really hazy thing for a lot of us out there in the consumer world. How big of a factor is that in the commissioner's proposal looking forward in terms of whatever rates are going to end up being?
Sure. Well, the Independent Insurance Agents Association commissioned work to be done on what factors could help insurers come back to the marketplace. And that work indicated that the biggest factor was to be able to get to include the actual cost of reinsurance in your rates. And that's because the reinsurers are already all using cat modeling and have forever, so their rates are already what they need. The problem is that, the admitted companies can't afford the reinsurance because the admitted companies aren't getting the rate that reflects cat modeling or the cost of reinsurance. So that was the biggest factor. And I think that's still true.
So you see that as something that could have a really big impact?
Yes.
Okay.
Yeah,
And
no,
Roger?
absolutely. I mean, you've two big things. You've got to include that. I mean, when you really look at the commissioner's program, there's nothing revolutionary there. It's what every other state in the union allows, companies to do. What he's done is said, if we allow you to do that, you also have to write insurance and you have to meet the 85% standard or whatever the case may be. So, I think it's really critical that we get, that program implemented. Unfortunately, it's not yet. But once we do, we think that that will help alleviate the marketplace and hopefully bring back a competitive marketplace, which is going to be positive for everybody.
Allowance for reinsurance is a huge piece of the functioning of the market. Insurance companies are basically risk managers, and they will manage their risk by trying sometimes to spread it around if they can. Currently, they're limited in that. But to be able to have reinsurance, for insurance companies to have reinsurance protection, is an extremely important part of their risk management strategy.
Alex, I know this is not, a policy thing is not what you want to weigh in, but as John mentioned, the reinsurers have been using cat models for a very long time. Are they any different than what we're talking about using now?
The way I interpret the new regulations is that the reinsurers who are using the cat models and then the current insurers would be allowed to use cat models. And so there would be a consistency then in the way that these two different entities are evaluating the hazard. So I think that would create, I guess, a self-consistency, right? In the way that the hazard is evaluated. And
Just really quickly too, are most of the reinsurers offshore? They're not, are the biggest ones like in Europe?
Go ahead.
Yes,
Okay,
yeah, or Bermuda.
okay.
I mean, the problem, insurance and capital for insurance is worldwide, and it's all connected. In terms of who are the reinsurers, who's the non-admitted market, the ability to capitalize new companies. I mean, it's all connected in terms of people that are willing to put their money on risk. And so, yes.
I was not making a tariff reference, by the way, just so you know.
I would just add, I mean, I get asked a lot, why do companies use reinsurance? Why reinsurance is incredibly useful and very necessary. And I'll just underline why that is. Insurers obviously have to have a certain amount of capital or money in reserves for every policy dollar that they've written. So if they have reinsurance and then thus the amount of reserves that they have access to is larger, they can write more policies. It allows insurers to cover more policies in the state of California. So reinsurance is a good. The other thing I'd highlight is I just saw this morning that reinsurers out of Bermuda are covering $10 billion in the losses that occurred earlier this year. That's just as of right now. They are already contributing heavily to our recovery efforts. So reinsurance is not a scary or a bad, it's insurance for insurance companies. It's kind of boring. But the fact of the matter is insurers have been paying these costs in California for years. They have to, it's just a part of doing business. But under the sustainable insurance strategy, they can finally pass along a portion of those costs to consumers because that is part of the business that they've had to cover themselves and eat for years. And when you look at the losses that insurers have borne over the last, over a 10-year period in California, the popular number, we reference the NAIC numbers. For every $1 that insurers are collecting in premium, they're paying out $1.14 in homeowners coverage here in California in claims. Reinsurance is a huge part of that cost, and being able to have that recognized in your rate filings is really huge in our ability to continue operating and growing here.
Is there anything else, and Danny, I'll stay with you here, in the sustainable insurance strategy from the commissioner that we're paying attention to that I didn't mention here, because I mentioned reinsurance and the cat models? Is there any, I know it's a lot of stuff. What else are you guys really paying the most attention to going forward, watching for implementation?
I'm really afraid that this phrase is going to be on my tombstone someday. I say it so much, but insurers need adequate rate in a timely manner. That is, that is what it comes down to. And so the rate filing process and the time that it takes to get a rate approved in California is a huge issue for insurers. We can have access to cat modeling. We can have the ability to use reinsurance. But if it takes a year or more to get your rate approved and it's already undervalued by the time you get it approved, that's a problem. You know, insurers in California have long operated under Prop 103, which is a lengthy process and always has been. But in the highly inflationary environment that we're coming out of following COVID and appear to still be in, you know, when the things that insurance is paying for, lumber, new cars, rental cars, when all of those things have gone up 30, 50% over the last 5-year period, if insurers can't have that reflected in their rates, or it takes them a year to get a rate approved from the department, that's a huge barrier to their ability to write in California, to grow in California. And California is a huge outlier. We're not the only prior approval state, meaning, you know, in California under Prop 103, in order to sell insurance, increase rates, decrease rates, we have to file with the department. It's a prior approval state. There are other prior approval states, and we're truly in a league of our own for how long it takes. If you look at New York, 62 days. If you look at Texas, 68 days. The average time to approval in Florida is 158 days. California is over a year. That is remarkable. And so when we look at the sustainable insurance strategy, one prong of that was mentioned in the governor's executive order and in the original unveiling of the sustainable insurance strategy was this notion that this process needs to be faster. And so that's something we're really watching and hoping for some movement on.
Yeah, if I could reiterate that, every insurance company has a story where they've had a rate filing for 2 years or 3 years. I think the average was after 2020, the number of filings were cut in half. The average time for an approval was doubled. So that's what companies have been dealing with, and that has to change. As the commissioner said himself, Prop 103 had a 60-day deemer. If the rate hadn't been approved, it would be deemed approved. And you know, the department for many, many years now has forced companies to waive that deemer. And so then you're at, you know, really at the, you know, at the risk of the department. I mean, you just, you know, the department can continue to ask questions, continue to challenge your policies, all kinds of different things that have gone on, and hopefully that will change. And I think under the commissioner's program, he intends to have that changed. And you know, I think we have kind of a 4-month program now that is going to be the standard.
We've been talking a lot about Prop 103 for a very good reason. Roger, you noted how difficult changing it's going to be. It makes me think a little bit of Prop 47, which seemed to be sacrosanct here too. Actually, it passed overwhelmingly, and then an attempt to reform it was rejected overwhelmingly, and it was a done deal. It will never change. And then last year, Prop 36 tilted everything up on its axle, right? I'm kind of curious, just looking ahead, given the nature of this crisis, do you think we might actually see a Prop 36 type of effort, Prop 36 type effort aimed at Prop 103, where against the odds, I guess, we could see another ballot measure that addresses some of these things. And is that a good thing to go about it that way? I'll start with you.
Well,
I can see John is just dying to weigh in on that.
I will grant that it was not a good thing to pass Proposition 103 in the first place. So continuing to jigger it with propositions could seem to be questionable. But the problem is we have an insurance market that is not working, and a good deal of the reason why is because of the tenets of Proposition 103. Now, to the point of it a phenomena developing, as did with Proposition 36 and previous tries. Proposition 36 was written somewhat different than previous tries, number one. Number two, there became a consensus among the population of California that we had a problem with crime and that we have a problem with substance abuse, significantly greater than it was before Proposition 47. That consensus developed, and therefore 70% of the people voted for it. I don't think we're there with Proposition 103 because I hate to say this, but a lot of people think the problem is the insurance companies. And I experience that in discussions that I have with people. And I try to explain to them the effect that Proposition 103 has on the marketplace and therefore on the insurer's ability to do business. But I have to say that I have not been very successful at changing minds. So there is not a consensus on that. If there could be a consensus that this dysfunctional marketplace is because of a proposition that we all passed, well, maybe 50.02%. I forget what the difference was, but it was very narrow, that percentage of the people thought it was a good thing. Problem is, a whole bunch of those people aren't even alive anymore, and most of the voters we have today weren't even voters then. So it's a tough one.
John, you're dying
Yeah.
to weigh in,
Well,
please, too.
Proposition 103 passed by 0.6% of the vote because people were mad at insurance companies about auto insurance rates. There was a lot going on also with competing initiatives and things like that. So maybe if that hadn't, some mistakes, if that hadn't happened, maybe it wouldn't have passed. But it did pass for that reason. We're looking at a situation right now where the senator's right. A lot of people are just mad at insurance companies, and they're mad thinking that their average $1,400 homeowners insurance policy at some point is going to go back to that rate, and it's not. I mean, when you look at California is now a catastrophic state, just like Florida, Louisiana, Oklahoma, Texas, Kansas, Colorado, those types of things. And when you compare what they pay for homeowners insurance, Florida, $5,500, Louisiana, $4,200, Oklahoma, $4,700, Texas, $3,700, Kansas, $4,600, Colorado, $3,000. What we risk here in California is another 103, but it's an initiative that it's not going to help the insurance companies. I mean, I think that's the risk out there. People are not going to be happy when they see their new rates, even when, hopefully the market becomes so competitive that these numbers go down, but they're going to be quite a bit higher than they used to be.
Denny, did you have a thought on that?
I appreciate the thoughts on our popularity, Senator. Yeah, I think we're under no delusions that we're in a position to run a proposition to reform Prop 103. I think the conditions that led to the passage of Prop 36, we haven't maybe reached that point for Prop 103. I certainly hope we don't. But I just don't think the voter sentiment is quite there. And I would agree that I think at this point there's a lot of there's more fervor for how do we make these companies stay here and write than, well, what reforms are needed to actually make this a functioning market.
Alex, I promise I'm not ignoring you on purpose. I want to start talking about climate change. So I'm going to throw the lifeline to you here because I'm not a scientist, but you are. So we've been talking a lot today about mitigation and incentives for homeowners and commercial operations to mitigate their risks. So let's talk a little bit about that and what that actually looks like. And one of the things that the question I guess we have here is things like changes in precipitation as an example, something you brought up to me, and how it affects the fuels of fires, how changes in temperature affect things like moisture level in the air, and just all of these things that are very scientific. How do we go about quantifying the impact of some of these things? And feel free to add anything else to this, because I know you offered me some other good suggestions. How do we go about quantifying this in a proper way so that the companies and the policyholders are all getting a fair shake when it comes to considering the reality of climate change and the possibility, and the likelihood of it getting much worse in the near future.
Yeah, so I think that we want a market where we can quantify the hazard and in an accurate way. And the difficulty is that we can't really fully do that right now. And I think even different CAT models have different outcomes and different quantifications of the risk. And so if you look at some of the factors that we know are changing, it's the changes in the hydrologic cycle in California. So probably we're getting a little bit more precipitation in each storm right now, even now. So that means that we're getting a little bit more accumulation of fuels during the wet season. And then we have our typical hot, dry summers, which are drying out vegetation and probably doing that quite a bit more than they used to, and that's probably an effect that we're very confident in. And when fire season rolls around, that means that we have a little bit more fuel and it's drier, and that's a recipe for a bigger fire. At the same time, we know that when the fires do occur, the behavior of the fire is sensitive to how hot it is. And so that means that these fires are larger just because when the fires are occurring, it's warmer on average. So those are some of the factors that are changing, and I think we have quite a bit of confidence in the warming component of that. At the same time, we know that wildfire risk is shaped by other human factors like fire suppression in forests has led to a buildup of fuels over a century. And that means that that's another reason why the fires are bigger probably in the forested part of the states. In Southern California, we have a totally different dynamic where we have had too many ignitions in a region that has very few natural ignitions. And so we have a fire surplus in Southern California. But the excess human ignitions means that we also have a lever there to pull. So I think going forward, we can think about reducing wildfire risk by better forest management, by reducing our fuels. And we can also think about in shrublands and in urban areas in Southern California, reducing human ignitions. Those factors would, I think, reduce our overall risk. And that's another way to mitigate this whole crisis is to mitigate that overall background risk. But we don't fully, I think we're still trying to quantify that.
How do we incorporate some of this data into these models? And I'm thinking about it from a policy perspective because, Senator, you sit down and to look at legislation and you're working off a set of data, let's say. But if that data is going to change rapidly all of the time, how does somebody like Roger introduce effective legislation when everything he's working with right now, it's kind of like AI, could change tomorrow or the next day, right? So how is it even possible for us to accurately incorporate all of this data in a way that's going to have some longer term use? Or is this something we're just going to have to factor into changing all the time and updating these models all of the time?
Well, I often say that we legislators know a little bit about a whole bunch of things and a whole lot about not a lot of things. So we need really good advice, number one. With regard to climate change, this is a tough one because it's kind of an exercise of the faster we go, the behinder we get. Because of all of the greenhouse gas emissions reductions that we've achieved in California, which is what AB 32 charged the Air Resources Board to do, and they've done a great job of that. It's had no effect on the atmosphere. And that's why we're continuing to see climate change progress. How fast, we don't really know. But California accounts for a little bit less than 1% of global greenhouse gas emissions. Just the coal-fired utility plants in China, just those emit about 70 to 75% of the greenhouse gases that are emitted by the entire US economy. So we're leading the world, and that's great, but it has economic consequences. And I'm not saying do nothing. Some people say, well, that just means we're not doing enough. We cannot cure climate change by ourselves. It is most definitely a global challenge. But every measure that we take to reduce greenhouse gas emissions has economic consequences. And those economic consequences have consequences on our ability to pay for mitigation, forest management, water storage, all of those things. So this is a vexing challenge among an environment where climate change continues to march on, no matter what we do about our greenhouse gas emissions, no matter what. So I hate to be pessimistic, kind of like reforming Proposition 103, and our scientists may have a comment about what I've just said.
I am not the scientist, but I do have a thought. I'm going to mess up the exact date and everything. This is what happens when you tell a story you weren't planning on telling. But I was at a conference and they were talking about how one of the world fairs in the early 1900s, they unveiled the light bulb and, electricity. And initially the insurance industry said, well, this is a fire risk. How could we possibly, allow this in homes? And, we may be known for being boring, but we are innovative, and we knuckled down and created Underwriters Laboratory, or we created what became Underwriters Laboratory, and established standards for the use of light bulbs and electricity in our homes. And I think we're still leaning into that. How can we deal with this new risk that we're facing via climate change? And that's why IBHS is so important and their work is so important. And it is evolving. And I think from our perspective, that's why it's so important that when the legislature looks at this, rather than being overly prescriptive that, these 5 things need to be done, this is the list, and then trying to revisit that every year with new legislation, from our perspective, the wiser thing would be to allude to standards that are being created and will be updated by entities like CAL FIRE, like IBHS, so that this can be a living document. Because to your point, we don't know all of the ways the risk is going to evolve, but we need to be flexible.
Climate change, I think if you look at the legislature and bills that have been considered for the last, 5-10 years, climate change has got to be the #1 issue in California in the legislature, maybe followed by homelessness. But I've actually written an article that said wildfires, or fires in general, whether it be wind-driven wildfires or wildfires, should be the #1 issue, because right now the state of California is foisting billions of dollars of cost on taxpayers and residents of the state in the name of climate change and making changes, whether they be electric cars or furnaces or whatever the case may be, but in order to reduce greenhouse gases. But the 2017 fires alone wiped out 20 years of reduction of greenhouse gases. You can imagine what all these other fires have done. So life, the loss of property, the health effects, the effect on housing, the insurance costs, you could go on and on. Resiliency is the big elephant in the room in terms of what the state has to do. And I think it's going to have to be the federal government, the state and local governments that have to do the hard work first. And the money's not there to do it. We're talking about something that's not a sexy subject, that's going to cost arguably a couple $1 billion a year. You have to go back every year to do it. And if you look at kind of the numbers so far, we're not getting to or achieving the goals set even by Jerry Brown 10 years ago on prescribed burn or forest thinning. The budget, even in our surplus time, we had a $100 billion budget. The state had budgeted $2.8 billion. I think they increased it by $1 billion to $3.8 billion for resiliency issues over 3+ years, and that money hasn't been spent. So we have to do more and more of that. I'm really heartened by the fact that of the 4 wildfire packages that were introduced this year that represented over 90 bills, most of those bills went to resiliency issues, planning issues, water issues, things like that. And I think the message is finally trying to get there. The governor has a state of emergency on that now, but it's a tough one in a deficit budget situation because it takes a lot of money and it takes a lot of people to continue to do this. I think the Pro Tem has a bill that would keep the temporary fire crews employed year-round to do fire breaks and other resiliency work, and that's essential to do.
You read my mind because I was just about to ask you if you were referring to that. So Alex, please.
I was just going to jump in. You know, I think that, yes, we can't do a lot about global climate change. I think we're subject to other countries' decisions there, and including our own. But I do think there is a lot of room for innovation in resiliency. I've been so heartened to see my colleagues really jump in and do innovative research in response to the fires that we had in LA. So some folks are working on this issue. I mentioned the ignitions issue and how we're in fire surplus in Southern California, and that's because we have 20 million people there who are doing things, and we have power lines causing fires, and we have fireworks and vehicles sparking and gender reveal parties and all kinds of things that are causing fire during fire season. So one group of folks is creating a Santa Ana classification system, much like our hurricane system, where we can really identify the types of Santa Ana events that are very likely to produce very large fires and in which locations, so that we can do things like shut down power, shut down access to wildlands, really make sure that we are controlling ignitions occurring in those places. So that's an example where I think we can take measures to try to reduce the.
Add to that, I think, Nicole, is it KB Homes? Started calling you. I'm really heartened to see some activities that like the builders have undertaken in California. They've really leaned into this idea that new communities that they're building need to be resistant to wildfires. So there was a demonstration I think last month down in San Diego area. KB Homes development. I'm in no way affiliated with them. I'm just giving them a plug. They built a community that they believe that adheres to all the science that we have right now on preventing the spread of wildfire. And they also have pointed out that this community could be a buffer to other communities that are existing communities that may not have the same stringent protections in place, because from what I understand, building new communities to these standards is actually not that much more expensive than building communities to, not below the standards. But it's getting existing homes and communities to undertake the investment, and that is where the state investment is going to be really crucial to that.
I'm really glad you brought that up, because I did want to talk a little bit about maybe the role that the home building industry plays in all of this. It's funny, my wife and I are we're in the home market right now, and we were meeting with our real estate agent last night, and everything's all good. And then we brought up insurance, and it hadn't even occurred to me what a role that is playing in new and existing home sales. So it made me think, okay, well, all right. What role maybe does the development industry have to play in this insurance crisis that we're having here? I mean, am I out in left field here? Or, whether it's building in greenfields or emphasizing infill or having standards there that would help make the property more insurable? I mean, is this a realistic thing to look at going forward? And John, let me start with you.
I'm not an expert on that at all, but I did hear in the aftermath of LA fires some discussion of how we protect existing communities. So the discussion was around homes that are very close together, and if there's anything you can really do to keep fires from going from one house to the next house to the next house. And one of the discussions was we can't do anything about changing the lot lines of those homes, but we can try to encircle those communities like a moat, with projects, whether they be condos, apartments, this and that are hardened so that the fire will stop at some point. Now, mean, that's all hearsay for me. It's the only thing I could come up with in response. But I think that that's the kind of science and that's the kind of thought process, we're going to have to build into planning of communities, and hopefully something like that works. And on the real estate market, I think, just like when interest rates go up, housing prices go down to reflect that. I think, we're also seeing that in the insurance, with insurance having an effect on the cost of housing. And we're going to see more and more of that, I think.
I think we probably will over time see building standards change at the local level. In order to harden houses, they have to be fundamentally built differently than they currently are. Not just in terms of defensible space, but the building materials themselves, the external being stucco as opposed to wood, the vents on the roof being protected from embers. All of these sorts of things are not currently strict building standards. I think, I'm kind of thinking that's probably going to happen. But we got a lot of existing houses out there. And with some, given the size of the property and the type of trees and landscaping that's there, in order to harden some houses, it could cost as much as replacing the house. And why would somebody do that? Or a good significant percentage of it. So existing homes is going to be a bit of a challenge. And the other thing about fire risk in residential areas is all of the things that need to be done to harden an area kind of work counter to the popular notion of community development to this point. More dense building, infill building, creating houses that are all that much closer together, John's comment notwithstanding, increases the fire risk. So we need to come to grips with that. I'm not exactly sure how. It could be actually moving in the direction of more greenfield development as opposed to infill, which is going to work entirely against the popular notion of the professional planners' conception of community development. But if you have greenfield development, you can build communities as they should have been in the first place. So we may see a bit of a political battle over this, but I think things are going to change.
Well, we have time for some questions. So if Tim, you want to?
Okay. I do have
Okay.
a quick question for you. So from the federal level, we're seeing lessening of funding of things like the National Oceanographic Association. And from what I understand, this will limit reporting on things like extreme weather effects. I'm wondering if that is going to have an impact on us being able to prepare. I know the professor had mentioned that you're working on kind of early warning systems and things like that. I'm wondering if those funding cuts are going to directly impact this, or if you have any idea how that might play out.
Yeah, no, I think that we're all very concerned about loss of data, loss of reservoirs of data. There are already data sets that are being lost. We're trying to download them as fast as we can to make sure that they're available going forward. But a lot of satellite observing systems are probably going to end. So we're going to lose that continuity. And that's important not only going forward, but also for understanding of the historical record. And a lot of our understanding about fire behavior, for example, is built on the history going back. And if we lose those records, we're going to lose that ability to analyze that data. So I think there's no question this is a serious issue. And over time, I think our ability to understand these dynamics will be degraded. Not to mention that we're actually losing our monies to do the analysis. The research projects are being defunded.
So it sounds like almost everyone in the room can stipulate to the demonstrable facts that climate change is increasing the frequency and severity of disasters, and that a consequence of that is that billions of dollars of additional costs are being foisted upon the insurance industry. what I'm hearing from this panel seems to be that the solution to that, to make up that funding shortfall, is to provide the insurance industry the regulatory tools to more easily foist those costs upon to the consumer and the ratepayer. And so my question is, why shouldn't the oil and gas companies that contributed to that climate change in the first place also contribute to the cost instead of just foisting it upon the ratepayers?
I'll take a stab at that because it would do the same thing. To the extent that you add additional costs to any company for any reason, it's going to translate to an additional cost of its product. It's kind of a vicious circle. Now, your premise is that the risk of houses burning down should be the responsibility of somebody other than the homeowner. And what I would suggest is a homeowner owns a house, he or she is responsible for that house and what happens to it. And they mitigate that risk by buying insurance. And therefore they pay a premium to mitigate that, and that funds the protection in case their house burns down. Now, if their house never does burn down, they've paid a whole bunch of insurance premiums over the years for nothing. But if they have a fire, then obviously it protects them. But to begin with the premise that the responsibility for the loss is fundamentally that of somebody other than the homeowner is kind of I think that's a failed premise. And to the extent that you try to spread those costs to others, you're just going to increase the costs to those people in another area, like how much they pay for gas.
That's exactly what insurance does. It collectivizes risk so that people who aren't affected are paying for the people who are.
I agree with you, but if you're going to impose those costs on other companies that also provide a product to consumers, like gas companies, you're just going to increase the cost of gas.
Or decrease their profit.
Yeah. I mean,
Well, if you want to have profit control, we already debated that in the legislature, and the majority party was not willing to go in that direction.
We have a question down here in the front.
Hi, thank you so much for informing us about the state of the insurance in California. I had a question about the future of the 3D building industries in helping the insurance companies lower their costs.
I got my own, thank you. I'm sorry, what type of companies?
3D buildings, so basically they print houses. And they use cement and construction. I'm actually working on a couple of projects, and they're trying to locate their companies here in California. And the way it goes, it's basically they have all these big trucks, and then they design and they build their building without minimizing the costs.
This is like the Three Pigs homes, you know, whether you build them out of straw or rock or cement or whatever the case may be. If everybody wants to build their home out of cement, I think, you know, and we encourage that, and, you know, I mean, that's going to be more fire resistant. But I did hear a story about somebody in the Santa Rosa fires that was in a very affluent neighborhood, and they built what they thought was a fire resistant home, which was basically cement, rock, steel, and glass. Fire burned so hot it melted the house. You know, it was like a $4 million house. But yeah, I mean, that's a 3D homes is maybe something that contribute on a very small scale to you know, home hardening, but that's as far as I see it.
I would just add, I think, you know, John, you touched on an important point. Unfortunately, for wildfire risk, there's only you can do a bunch of things to lower your risk. But different than hurricane risk, for instance, you could mitigate your home to the hilt, but if the fire is burning that hot, or if your neighborhood is not, you know, the importance of community level mitigation for wildfire in particular is, it can't be understated. Whereas if you mitigate your home against hurricane, it doesn't matter what your neighbor has done, it doesn't affect the mitigation for your home. So I think that's, you know, part of the challenge is getting entire communities to buy in.
I think we have time for one more.
Yeah, I think this is our last question.
Thank you so much. Really interesting discussion. John, this might just be for you, but Senator, you may have some insight. So I know that the California Earthquake Authority has been issuing catastrophe bonds as a strategy, and I think the last round they wanted to do more. There was one insurer that kind of wanted to, was not enthusiastic about that approach. Have we seen that strategy work for the CEA to moderate some of the costs of the reinsurance they have to buy?
So as I understand it, and we've all talked about reinsurance here. Reinsurance at some point gets too high. The alternative are catastrophic bonds. And when some of the market moves to the lower cost catastrophic bonds, and the reinsurance costs kind of come down. That's why I kind of understand the mathematical equation is out there. When I talked about the FAIR Plan and 226, right? AB 226, it was that more of issuing bonds to manage cash flow. And I think I did call them cat bonds, but I didn't mean it that way. So I'm really not all that familiar with what the CEA has done. Thank you.
There's been talk in the past of collectively insuring for disaster losses, taking a national look at it, because some areas have tornadoes, some areas have hurricanes, some areas have earthquakes. Wildfires are probably more consistent in a lot of areas. But there have been talks in the past to aggregating those risks and insuring for them all kind of at the same time, sharing the risk. People at risk to earthquake sharing their risk with people who are at risk to hurricanes. Nothing's ever gone in that direction, but perhaps this crisis might resurrect those discussions. It was an issue when I was in the Assembly. I haven't heard anybody bring it up since I was in the Assembly a century ago. Just kidding. Haven't heard anybody bring it up now, but maybe it's time to start looking at that again.
And with that, I think we are definitely on time here. So thank you all very much. Thanks to our great panel for coming up today and sharing all of this great information with us. Thank all of you. Thank you to our sponsors. And July 8th, correct, Tim? Please, our next conference will be on California and AI. Hopefully we'll see you all there. Thank you.
Recording stopped.